In 1985, 5 nations signed a secret agreement that crashed the Japanese economy for decades. The same currency war tactics are being positioned for 2025, and this time, the global fallout could be catastrophic. September 22, 1985. 5 of the world's most powerful nations gather at New York's Plaza Hotel to sign an agreement that would reshape the global economy for decades to come. The Plaza Accord, a coordinated intervention that forced Japan to artificially strengthen its currency against the US dollar by a staggering 51%. Overnight, the rules of global trade changed. Japanese exports that had been flooding American markets suddenly became uncompetitive worldwide. A calculated currency manipulation that would ultimately bring Japan's economic miracle to its knees. Behind closed doors, the United States had orchestrated this financial maneuver with surgical precision. Facing a massive trade deficit and watching its manufacturing base erode under Japanese competition, America wielded its diplomatic power to protect its economic interests. The message was clear. Currency values were no longer determined by market forces alone, but by the will of dominant nations. What unfolded after the Plaza Accord revealed the true nature of currency wars. By artificially manipulating exchange rates, countries discovered they could weaponize currencies to achieve economic dominance. The international monetary system, designed to facilitate trade, had transformed into a battlefield where financial policies became instruments of economic warfare. As we look ahead to 2025, with US-China tensions escalating and markets showing troubling signals, the shadows of the Plaza Accord loom large. The question isn't if currency wars will erupt again, but when, and at what cost to the global economy. The Plaza Accord's currency manipulation triggered one of the most spectacular economic collapses in modern history. Japan's once soaring Nikkei index hemorrhaged an astonishing 80% of its value. Real estate, the backbone of Japanese wealth, crashed even harder, with prices in major cities plummeting by an almost unbelievable 87%. The economic carnage was total and merciless. In Tokyo's Ginza district, land once valued at over $1,139,000 per square foot crashed to a fraction of that value. Entire neighborhoods that once symbolized Japan's economic miracle stood abandoned, monuments to financial devastation. Desperate to revive their collapsing economy, Japanese officials slashed interest rates to near zero, an unprecedented move that was supposed to be temporary. Instead, it created a new economic horror. Zombie companies, failed businesses, kept artificially alive by cheap debt, consuming resources while producing little of value. The Bank of Japan's balance sheet ballooned as it pumped trillions of yen into the economy. Yet recovery remained elusive. Executives at these zombie firms clung to their positions while innovation stagnated and productivity collapsed. What followed was not a recession, but something far worse. 3 lost decades where time itself seemed to freeze for the Japanese economy. Multiple prime ministers launched more than 15 major stimulus packages. The Bank of Japan pioneered quantitative easing and even negative interest rates. Yet nothing worked. By 2020, Japan's economic output remained essentially where it had been in 1995. An entire generation had grown up knowing only economic stagnation. The Plaza Accord's currency manipulation hadn't just triggered a recession. It had stolen Japan's future. Fast forward from 1985 to today, and we're witnessing what many economists fear is history repeating itself. China's recent 84% tariff retaliation against the United States marks a dangerous escalation in global trade tensions. The parallels to the protectionist environment that preceded the Plaza Accord are striking. Both eras feature major economies using trade barriers as weapons, creating economic uncertainty that ripples across global markets. Just as Japan faced mounting pressure in the 1980s, China now stands at the center of America's trade crosshairs. The yuan-dollar exchange rate has become perhaps the most contentious battleground in this economic conflict. Washington repeatedly accuses Beijing of currency manipulation, deliberately keeping the yuan undervalued to boost exports. China fires back that the U.S. weaponizes the dollar's global reserve status, using it to export inflation and instability to emerging markets. This currency standoff mirrors the tensions that eventually forced Japan into the Plaza Accord's devastating revaluation. Financial markets now find themselves caught in the crossfire, with volatility spiking whenever new threats of currency intervention emerge. Investors who remember how Plaza Accord-style interventions crushed Japan's economy are growing increasingly anxious. Stock markets whipsaw on rumors of potential currency devaluations, while bond yields reflect the uncertainty plaguing the global financial system. The question on everyone's mind: are we witnessing the opening moves of a new currency war that could reshape the global economy for decades to come? As the dominoes of global finance teeter on edge, we're seeing unmistakable warning signs of currency war 2.0. Central banks worldwide are hoarding gold at unprecedented rates. Russia, China, Turkey, and even European nations silently building their reserves. This isn't coincidence, it's preparation. Countries are hedging against currency instability and potential dollar devaluation, creating a golden safety net for the approaching storm. The parallels to 1985 are striking. Today's America faces the same pressures that triggered the original Plaza Accord: a stubbornly strong dollar crushing exports, widening trade deficits exceeding $1,900 billion annually, and manufacturing communities hollowed out across the heartland. These economic wounds create powerful political incentives for currency intervention, especially with an election approaching. The temptation to artificially weaken the dollar grows stronger by the day. But 2025's battlefield looks radically different than 1985. China and other nations are advancing digital currencies and alternative payment systems that could fundamentally rewire global finance. The Chinese digital yuan, cross-border CBDC bridges, and declining dollar usage in international trade create new vulnerabilities and tactics unavailable during previous currency conflicts. As these forces converge, we stand at a historic crossroads. The next currency war won't simply replay history, it will rewrite it, with weapons the architects of the Plaza Accord never imagined possible. As history teaches us, currency wars leave many victims in their wake, but also create opportunities for those who understand how to navigate these treacherous waters. When Japan's economy collapsed following the Plaza Accord, a striking pattern emerged. Japanese investors with assets diversified across multiple currency zones preserved their wealth, while those with domestic-only portfolios witnessed decades of savings evaporate. The contrast was stark. A 50-year-old with global investments maintained purchasing power, while their neighbor with purely Japanese assets postponed retirement indefinitely. Throughout history, certain asset classes have consistently weathered currency manipulations. Precious metals, particularly gold and silver, provided a reliable store of value when paper currencies faltered. Productive real estate generating income in essential sectors maintained its intrinsic value. Strategic commodities, energy, agriculture, and critical materials have repeatedly served as hedges against currency devaluations, offering protection when national currencies collapsed. Perhaps most valuable is the skill of reading political warning signs before markets react. Currency interventions rarely arrive without precursors: deteriorating trade relations, increasing nationalist rhetoric, and unusual central bank activities typically precede official announcements by months. Today, as we witness escalating US-China tensions and whispers of a new Plaza Accord targeting the dollar, those who recognize these patterns can position themselves accordingly, not as victims of the next currency war, but as its survivors. History doesn't repeat, but it often rhymes. Stay vigilant, stay informed, and position yourself wisely for the currency shifts that may reshape our global economy in 2025. Subscribe to RockVein for more financial insights that prepare you for tomorrow's economic battlegrounds. Share your thoughts on which currencies might face pressure in 2025 in the comments below.